Well, hi, and welcome to the Consider This program. I'm Joe Clark. Happy to have you along tonight, along with
Angie Kinzer.
What a wonderful evening. Welcome to the middle of crazy August. If you've not been paying attention to the market, we do this live, obviously, if you're watching it here on Tuesday nights. But it's also replayed on Saturday morning. I can't tell you what's going to happen between now and then. I don't have a magic or a little Rubik's Cube to try to figure that
Crystal
one out.
ball?
Crystal ball. But what I will tell you is today was very, very eventful. We had executive orders come out of the White House to help take care of some of the issues that are going on with Congress not being able to get to an agreement in terms of things. I think that drove the market higher. And then, Angie, all of a sudden in the last hour, the market kind of peeled off. So a very, very eventful week, but welcome to August and welcome to Consider This program. So, Angie, I know you've got a couple true-false questions from your trip. She just got back from Boston.
I did. I had never gone to Boston, so I went to Boston. I spent the day there. A lot of history in Boston.
A lot.
Not the day, the week, actually. But one of the tours that we did was the Boston Tea Party tour. So I came up with 3 true-false questions for you. First question. Most of the tea from the East Indian Trading Company was actually from China, not Britain.
Ooh. Boy, China grows a lot of tea. Britain owned the seas. I'd go, that's true.
It was true. It was mainly Chinese tea. It was green tea,
Still
too.
being taxed,
30%
however.
of it.
Still being taxed by our friends across the pond.
Yes. And 30% of it was green tea. Okay, second question. There were actually 4 ships in the harbor the night all the tea was dumped.
Now, why would I know that?
Because they talk about 3 famous ones.
I don't remember the 3 famous ones, but I would imagine there probably were 4 if they talk about 3.
Nope, it's false.
Oh, there we go.
There was a 4th ship called the William, and it ran into
I was right.
It ran into a storm on the way there, so it never made it.
It died.
And then the last one, there was a man that actually died at the Boston Tea Party. True or false?
I believe that's true.
It is false, but John Crane was knocked unconscious during all the skirmish on the ship, and they left him for dead. They put him in a carpenter's place under some wood shavings, and he woke up a couple hours later.
What a tough life. All right, so I will give you one since we're talking about Boston.
Okay.
The famed Paul Revere.
Yes.
The night the Redcoats were coming, how many people actually rode saying the Redcoats were coming?
So there were more besides him.
There was more. Can't believe in all the years of history school that I had that I didn't know that. Paul Revere ran around, knew everybody, built all these relationships. He went one direction. Another guy, a real patriot named Mark Dews, went the other way. He knew nobody. So if you're riding a horse through town at 2 o'clock in the morning screaming the Redcoats are coming, and you don't know who the guy is, you don't know whose doors to knock on, bad things happen. Hey, it's not going to be bad things here. We're going to give you real things that you can use. We've got a lot of history to talk about tonight, but it really is helping you kind of understand currency and what's going on in some of this market about China, the Big Mac Index. Stick around. We're going to have a lot of fun, and welcome to Consider This program. Hey, for those of you that are watching live, don't forget you can send in your questions. Chris Rogers, one of our associate advisors, is standing by. If you send in a question or ask something, he'll be more than happy to answer it. We give you a little bit more content in this show than what we're able to give, obviously, people that are listening to it on the radio. Our friends on WIBC only get to hear 3 different segments. You're going to get 4 tonight, plus we have the ability to answer questions during this that we can't answer on the radio because it's taped. It's just it's the way it is. Everybody has lives and times to do. But we want to make sure that we share as much with you as we possibly can. So if you've got a question, go ahead and email us. You can go to yourlifeafterwork.com or submit it right there on Facebook, I believe. We're still working on how all the technology works. It surprises me, but questions show up all the time. So
yes.
we'll take them.
We'll take them.
All right, Casey, you ready? Good morning and welcome back to Consider This program. I'm your host, Joe Clark.
And I'm Angie Kinzer.
Happy to have you along, Angie.
Thank you.
As well as the rest of you. All right, you're in charge of the topic. What are we talking about?
We are going to talk a little bit about the history of hyperinflation and the argument against it. So I know that you actually know a lot about the German history and economy, and this was an idea you had way back when, which was I think the title was Printing Money.
Yes, a friend of mine who is is one of the most respected fixed income managers on the planet, is a guy named Lacey Hunt. Just a gentle giant and a great guy. Lacey believes that we are in permanent deflation, at least for your and for our generation. Maybe toward the end of the generation of the millennials that might change, but that's where we are, in his opinion, right now. Other people believe that we have put so much money in the economy, inside of the CARES Act that came out March 27th, that the federal debt that we already have, that we are stuck in a world of where you're going to have hyperinflation. And so I get asked this all the time to try to explain what happens in hyperinflation. So the last example, which nobody can relate to really, everybody could probably believe that they could relate to the German economy. Mm-hmm. So when I use Zimbabwe, and I tell you that I have $1 trillion Zimbabwe bill at home, I do. The Germans printed the money, and they had to pay for the currency to be printed before they would ship Zimbabwe the paper, because the currency was literally that worthless if you get down to the end. Okay, so and you know that could never happen to a civilized country. So it did, obviously. It happened to Germany.
Yes.
And what I want to, the preface for this that I want to give you is understanding that when I deal with people who have a $1 million or $2 million or more in an account, and it's true of people with less, but you have this, I guess, this belief that if somebody has that much money, they have an understanding of certain things. And if I had to pick one topic that people understand the least that have a lot of assets, it truly is understanding currency. Right? So we're going to spend a little bit of time talking about currency in this way, and we're going to spend a little bit of time talking about currency as it relates to China in the next segment, because that's stuff that we get asked about all the time, and we're in a very interesting period of an economy right now where people are asking questions. So I can't tell you if my friend Lacey Hunt is wrong, that we are not going to be in deflation. I can't tell you that we won't necessarily be into hyperinflation, though I will tell you it can become parabolic and just roll out of control very, very quickly, as we're gonna illustrate. And then Angie's got some questions. Or if we're just going to have a higher than normal inflation rate. It's going to probably be one of the three, and I can't tell you which one it is. We have to build portfolios that are able to deal and adjust with all of those. I am very, very willing to admit that we are uncertain how this will unfold. What I can tell you is that we are very consistent in how we manage any one of those environments, no different than how we manage today with our risk barometer and everything else. So way back when, there was this World War I thing that fought. Germany created a lot of challenges as far as France, Britain, and the United States were concerned. At the end of the day, the winners always get to declare the rules. Right? So Germany, you were bad, had nothing to do if anybody else provoked the battle or not. That was absolutely immaterial. Germany lost. And because of the Treaty of Versailles, they ended up having to put together what a reparations package, if you will, to pay back the United States, France, and England. And under no circumstance was there any way that Germany could ever afford to pay it. Right? So I have actually, because my in-laws are wonderful people, found in envelopes marks, German marks from 1922, right, that are 100,000 at 8%, 50,000 at 8%, and 8% being the coupon payment that would come, right? I've got them in 1923 that have $8 million coupons. So you now have 1 million marks, right? 8 of them on one sheet, and one is ripped off. And, Barb's asking me, she goes, why is only one ripped off? Who wouldn't cash in $1 million coupon? Right. By the end of 1923, literally it was 43 billion marks, equaled a penny in our currency today. At the end of the day, under the Dawes Plan, which ended up failing also, obviously, but in 1924, we negotiated a deal where a new Reichmark was equal to a little over 1 trillion marks that was actually out there. They paid people 3 times a day. because they had to wheelbarrow money to be able to go buy bread. I mean, it was an insane period of time. And that's what happens when printing goes haywire. That's what happened in Zimbabwe. It's also what happened in Germany under the Weimar Republic. So people who understand history worry about that. We are nowhere near that. I mean, I don't think that's even in the cards.
So after the war, I mean, they held him responsible for this restitution. I think that
Reparations is what they called it.
okay, so it was like 132 billion gold marks or 269 billion,
Much more than a
like
dead economy
today's.
could do.
So
And what people forget is we actually loaned Germany the United States because we knew if you can't make anything, you can't tax anything. If you can't tax anything, you can't pay us back.
right.
Right. So we essentially loaned them $25 billion on top of everything else to try to help get this started.
So what did that do with their economy at that time when they had to pay all of that back?
Well, they ended up with a 50-year plan and paying back a lot less. I mean, France finally backed down. And the destruction over there, when you go to see some of the historical monuments, churches, places like that, and you see big bullet holes and cannons in churches and in important buildings from bombs that were dropped, it's amazing. Some of the stuff is actually still there. But it is...
So what would it look like if the U.S. had suddenly a new currency?
Well, the U.S. isn't going to have a new currency because you have, in the world we live in today, because of the way world trade works, everything essentially trades through the U.S. dollar. So it's converted from, let's say, from euros to dollars to get to yen. So you've got essentially the U.S. dollar and the Japanese yen that are kind of the stable things. China's kind of worked its own little deal out on the side with some other countries that it does trade with. But that's when they talk about the reserve currency of the world. I mean, that's where that really kind of comes from.
How does our monetary system work right now? I mean, compared to the old like gold standard? Or,
Well,
I mean,
under the gold standard, we, in theory, had gold that matched up with exactly the amount of currency that we had that was out there. Today, the Federal Reserve has a different job. They try to maintain full employment, which is typically an unemployment rate above below 4.5%, and watch for inflation. And so the battle that they're having today, and she's dealing with that deflationary side. So when you put money into the system, in theory, you have an inflationary pressure. That's why there are people very worried about inflation. It's just not been transpiring. Right? I mean, we have deflation. I talked a little bit about that on our market carver this week. That's our economic video that we send out that you can go to the website at yourlifeafterwork.com and get signed up for. It's a freebie that we send out every week. But that's so our monetary system is based on the promise to pay.
okay.
Right? It's not based on gold. It's not based on anything else. It's people are you're willing to work in exchange for a pay that I'm willing to give you. We manage money for people, do financial planning for people in exchange for money they're willing to give me. We invest in stocks that we think we can turn into money so that we can hire more Angies.
Okay.
Right? I mean, that's our monetary system. It's a promise to pay.
Well, we have a question from Tom in Alabama. With the dollar decreasing, should we be worried or is this a temporary issue?
Well, Tom, it's a great question and thank you, but it depends on who you're asking, right? So remember, if you're an exporter, if you're a company in the United States and you export to other countries, you want the value of the dollar to go down, right? And so that people can buy more of your product, if you will. On the other hand, if you're an importer, you want the value of your dollar to go up so that you can buy more goods and services, whether it be from Europe, Brazil, China, or wherever it is. So it's a constant battle that's here. The value of the dollar, and you've heard President Trump say this multiple times, the value of the dollar got so out of whack relative to other currencies that it really became frustrating. So we've got all these moving parts in these negative interest rate world environment we live in. What is a correct valuation? What is a right valuation? We've got a lot of foreign money that came in. Now you've really watched the euro have a nice little rebound. That's good for their economy. But the dollar's not fallen too far. It isn't going to fall too far. It isn't going to fall, in my opinion, too far. It should get down into what we would call parity with other currencies, which it's not at right now. Now, if you stick around for the next segment, we're going to talk about the Big Mac Index, and I'll explain what PPP is. And that's not the loan. That's purchasing price parity. And that's really where we're able to look at currency kind of a little bit less lighthearted to a degree, but to get an idea really about what's going on, to get a better handle on how some of this works. Great question. Appreciate it. I don't believe the dollar is going away anytime soon. But the value coming down will help in some of our areas. And in some areas, it has a natural hindrance. But the dollar did get too high. It fell quicker than what we would probably imagine. But hey, we're in 2020. We're in a pandemic. Remember, the S&P 500 fell faster than it ever fallen at any one time in history, and it also rose faster than at any time it had done so in history. So, interesting world.
We had a question last week, and we could maybe kind of tie this in because someone had asked how long it takes, or how does the emergency, like stimulus money, impact our economy?
Well, it impacts your economy very, very quickly, which is why people are worried at the end of September the extended federal unemployment benefits go away, right? And that is a huge concern because if people don't have emergency funds, when that money stops coming in, the brakes can go on in a lot of different ways. So that speed of money or velocity of money that we talk about is a different story. But when those $1,200 checks hit, we know exactly the number of them that showed up at brokerage institutions where people were essentially depositing money into brokerage accounts and buying stocks. They didn't necessarily need the money. Mm-hmm. That's creating part of our challenge in Congress. When you have 1 million accounts open up at TD Ameritrade with an average balance very near the $1,200, it's kind of, wonder where that $1,200 came from. Hey, you're listening to Consider This Program. I am your host, Joe Clark, along with my co-host, Angie Kinzer. So glad to have you all along. You got a question or comment, shoot us an email, considerthis@yourlifeafterwork.com, or give Angie a call at 800-928-4001. We'll take a break and be right back. Hey, Tom, great question. Appreciate it. Currency is a confusing thing, and as we move into the Big Mac chart, I think you will find it even more interesting if you've never heard about it before. A lot of craziness going on inside of the world, but Goldman Sachs made a pretty strong argument about where China is and what's going on, and so we're going to talk a little bit about that. But the Big Mac Index is a fun thing, and then you can ask your questions and kind of go from there, Angie.
Yeah.
All right. Casey, we're ready. Well, good morning and welcome back to Consider This Program. I'm your host, Joe Clark.
And I'm Angie Kinzer.
And we're happy to have you all along. Appreciate your comments and questions. Remember, if you're listening to us on the radio, we did this show Tuesday night live, 5 p.m. Eastern Standard Time. You can find it right on our website at yourlifeafterwork.com, streaming, where you can go in and ask questions, put in things. We've always got a planner available to answer questions. They will put it up on the screen, and we will do our best to be able to answer those questions for you. For those of you watching live tonight at 5 p.m., the reason I say good morning is because it airs at 6 a.m. on WIBC and various other radio stations across the country. So happy to have you along. Tonight, we're really working in these first two segments talking about history of currency and what's going on. Now we're going to move into where we really are with currency today, just to get an idea of some of the political environment that we are really in and that's going. There's a lot of questions that come out of it. I'm going to try to make a little bit of light of it. Where all of this originates really did start out as a joke, and after a period of time, people have begun to take it very, very, very seriously. So, Angie.
Okay, so China has more workers, so they have more output. But wouldn't that mean, explain that? I mean, doesn't that mean?
So when we're talking about currency, when we're talking about the finance world, and let's just start with let me give you a breakdown of the Big Mac Index since I kind of built that up. What you're talking about is purchasing price parity. So there's an exchange rate. You asked me in the last conversation how our financial system worked, right? Another question would be, who sets the value of our dollar, right? And that really is bottom line, what other people are willing to pay for the dollar, or the amount of money that they're willing to be able to put into the system, if you will. Now, how do we know that exchange rates are right? Howard Marks of Oakmark, a genius billionaire, been in the industry probably twice as long as I have, and I'm on year 32, right? And really has this understanding down, and he will not mess in the currency environment. He says there's no more perfectly matched market on an equal night than that. There's no inefficiency is essentially what he would tell you. When you look at currency, though, when you understand that the price is set based on how investment works and what other people are willing to pay for it, Apple has to buy currencies in other countries because they buy equipment there and they want to be able to hedge, if you will, the value of or the cost of their currency. No different than airlines do that with fuel and everything else. Well, this exchange rate issue becomes very, very interesting, and you'll hear people say that China's currency is undervalued, which is where you were trying to head, right?
Yeah.
And so in 1986, right, The Economist magazine actually created an index where it looked at countries across the world that had a very common item, and it was called the Big Mac. Right? So since the McDonald's was owned as a franchise system and arguably people had the ability to be able to negotiate prices, it was believed by The Economist as kind of a humorous thing that they could look at what a Big Mac cost in U.S. dollars in the United States versus other countries, Germany, London, China, Brazil, those places. And you can see that if you're watching us live, you can see the chart. If you go back and view this later on, you'll be able to see it. I also put this chart in the market carver again on our video that goes up. But what happens when you look at this, and the reasons that the lady did it, the economist who did it, who put the chart together, she was trying to look for purchasing price parity. So that means if it costs me $3 to buy a Big Mac in the United States, it should cost $3 or the equivalent of $3 of yuan to buy it in China. Well, turns out it really doesn't. And most of the time, it really hadn't happened. Now, it's not a perfect thing, but other people have come along and played with it. In 2004, a company tried to change it to Starbucks because there were now more Starbucks than there were McDonald's. In 2007, in Australia, they changed it to iPods. Right? The one that cracked me up, because I'm not an IKEA guy, is Bloomberg had the Billy Index. That's the price of a bookshelf that's called the Billy Shelf, I guess, Billy Bookshelf, and IKEAs that are all over the world. The point is they're trying to prove that there is a PPP, a purchasing price parity, to be able to say when currencies aren't valued and when they're not. And so you went to the workforce, which is an interesting part. You asked me that on China. If they already have more people, and go ahead and ask your question again. I won't put words in your
I
mouth.
just meant that they have more laborers because they have more people, so their output is larger. But
And that's the argument that came out of the Economist magazine this time, is if you removed, and this is the president's argument, it's people who really don't have an affinity for China. Let's put it that way. They believe that there is because they do set their currency rate. They do have a different ability to do that, where they're going to raise the value of the yuan or lower it. So in China, right now, if you looked at the United States economy, we're $24 trillion economy, right? China's about half of that. However, their currency is also so far down relative to what it ought to be that if the currencies were truly at parity, their GDP would already be greater than the United States, be closer to 26 trillion, according to the estimates out of The Economist, right? So when you talk about the workforce, part of our efficiency as the United States is figuring out how to do things bigger, better, faster, and cheaper, right? We're very innovative. We've used technology. We've got that going for us. They have the population going for them, and they have the ability to tell people that you will go to work, right? So it's a little bit different.
now, before the 1800s, was their economy stronger than ours?
China's economy for I don't know if I can say 1,000 years, but as the Great Wall was built and Genghis Khan died out and China kind of took back over, they were clearly probably the most powerful economy for an extended period of time. And all of a sudden in the 1880s, the United States just overtook them with our innovation. A lot of our stuff in the United States happened in 1903. Ford, Harley Davidson, Miller Beer. We learned a lot of ways to be innovative and creative that they just didn't keep up with. But that change really gets into some of the politics and some of the history that changed in China, at that period of time, the way they begin to believe versus how they'd believed before. But they still take a longer view of economics than we do.
We have a question from Jimmy in Utah. How can China manipulate the value of their currency and continue to get away with it?
Well, that's the whole point. Why do we play in their reindeer games? And that's that's what you hear the president kind of say. That's what you're, part of this goes back to the TikTok conversation that people are taking right now. How do they get away with it, and why do we continue to play? Well, they're the second largest economy in the world. We want cheap goods, and they're able to supply them because of, as Angie pointed out, that extreme labor workforce, that they're able to have. Now, I will tell you, from the business owners that we take care of, we're starting to see some of that work come back, migrate back to the United States. Just as Apple doesn't want all of their suppliers in one country, for geopolitical risk, economic risk, currency risk, all of the other risks that are there. That doesn't mean that they have a lot of people in the United States that are in the production of components, and it appears to us that you're going to start to see that change in this quote unquote new normal world we live in, where people don't want to get caught not having product when they need it.
As competitive as we are here, should we be worried about China?
Well, I'm a Reagan trust but verify kind of
Yes.
guy, right?
Yes.
I think we've got to pay attention to everybody we deal with. I think most people would be shocked the economic strain inside of the United States when Indiana fights for something against Illinois.
Right.
Right. I mean, should we be more worried about Illinois or more worried about China? Probably China. Should we be more worried about China than some people are? That gets into politics. It gets into beliefs. From a currency standpoint, eventually this has to get fixed, and I think the pandemic's going to work on a lot of things to try to get it fixed. But worried, I don't think we have to worry about them marching anytime soon, right, and coming
Right.
over. But the economic wars are real.
Well, remember our age group, it was the Soviet Union. We were everything we were worried about.
Angie and I grew up in a world where we were taught to hide under our desk in case of nuclear war.
Yep.
Like that was going to really help. That's why we're so undereducated, right? We had to spend time hiding in the desk, under the desk, in case there was a nuclear war. That never happened here in good old Indiana.
Well, lastly, is there any country that we'd never hear about is economically something that we should be talking about?
No, we have to pay attention, especially if you're in the trade world. Especially if you make parts and you export them. Or if you invest in companies that do that, you have to worry about currency risk. We had an issue a couple of years ago. Goodness gracious. It was when the dollar really started to rise. It was probably around 2010, 2011 era. And forgive me if I'm wrong on that period of time. But what was happening was the German index was up much higher than the United States index was. And I had people who would call in and say, Joe, why aren't we investing in Germany? And I had to explain that, well, we could have invested in Germany, and it would have been nice to say that we had that 30+% gain in that year. But in reality, our market outperformed it because the value of the euro had fallen so greatly relative to the dollar. And that's really where people it gets to be difficult when you do investing. The United States makes up about a quarter of the world's GDP, a little less, right? So in theory, a quarter of your money ought to be in U.S. stocks. Well, that's just not going to happen, right? We have maybe in a period of time when international markets are doing well, maybe you'd have 15 or 20% in international, right? You would never have all of your money over there. There are a lot less risks that are here because of our size, because we live here, because we trust the tax code, because of the way ownership works. It's an interesting world, but just never forget in your investments, ladies and gentlemen, to pay attention to how that currency plays into this equation, and understand, whoever you like or don't like politically, there is truth to this in terms of the way the currency deal works. The purchasing price parity is simply not there. Give Angie a call, 800-928-4001. Hey guys, thank you for the question. Appreciate it. There's an awful lot to understand about currency. I can't teach that in an hour. And if I was going to take as much time as I needed to teach it, I would actually bring in another teacher. That would just be the way that it is.
Speaking of teaching, tomorrow you're going to be doing a virtual lecture. actually live tomorrow at 1 o'clock. So if you call our office at 1-800-928-4001, we can give you a code to jump on that meeting. It'll be a real interesting webinar.
It's about 45 to 50 minutes. We'll take question and answer afterwards. It is my signature talk that I put together years ago. It's called Critical Tax Decisions That Will Impact Your Retirement. So we'll talk about how to read your tax return, how to understand how some of that is working and transpiring. Again, it's complimentary. We are looking for people who want to raise their hand and say they want a next steps meeting. That's why we do this show. By next steps, that's a meeting that we have with you individually, with one of our planning team, where we sit down and we'll give you things you need to consider today, things you're going to want to consider in the future. And then if we choose to partner together, we'll give you a written outline of these are the things that we will do for you as a company as we work in an ongoing relationship. So that critical tax decisions, it's complimentary. 1,000 people can be on, 10 people can be on. I will be here regardless of what that is. And I think it's at 1 o'clock tomorrow, Angie. Is that right?
1 o'clock tomorrow, and then on Thursday, 7 o'clock.
7 p.m.
Yes.
So you need to call Angie at our office at 800-928-4001. Obviously, prior to 1 o'clock, she'll be here. So you probably want to get that done sometime in the morning. But if you call and you want to join us, we're happy to have you.
Yep.
All right. What are we talking about next?
We're going to kind of switch gears and go to dealing with maybe some diminished mental capacity in our own home or with our parents.
Let's get excited about this.
Okay.
But we're going to let you answer. You're going to ask the questions, and I will go from there. I will give it a little bit of a framework. So,
okay.
All right, Casey. Well, good morning and welcome back to Consider This Program. I'm Joe Clark. Happy to have you along.
And I'm Angie Kinzer.
Even happier to be here.
Thank you.
I'm glad to have you back from Boston.
I know.
Where you had your clam chowder.
Chowder.
I don't.
Yep.
Yeah, I do like the. Haven't had it for a long time, but I do like clam chowder. It's,
they make
it doesn't really work on keto.
So many different ways.
No.
Okay, so we're going to kind of switch gears here and talk about dealing with diminished mental capacity in your own home or with your parents, which is probably a common thing.
It's a 3-layer onion, right? You have to potentially deal with your parents' diminished capacity. I don't want to say dementia in this segment because it's not really that we're dealing with right now. It's diminished capacity. And I think that's very, very important. So you've got to deal with yours. You've got to be able to deal with your parents. And you've got to have something prepared for your kids to be able to deal with you, right? So those are the 3 layers of the onion. I have seen all 3 be financially destructive. And I will, let's just start with the parents. I shouldn't say we all, I've seen clear parental abuse, but not by people we take care of. I think people genuinely care about their parents. It's just one of the 10 commandments. It's not a biggie, right? Mm-hmm. So as you honor your mom and dad, you're trying to take care of them. You're trying to respect their wishes, trying to respect what it is that they've done, and you want to help them to the best of their ability. And we all know many people reach a point in life where they simply can't make the best decisions. They have a diminished capacity. Many times it's physical, sometimes it's mental. And that's where it really gets to be very, very difficult. So you need a plan and a strategy to work on that. And we spend a lot of time helping counsel people. More importantly, we try to work with people like you who are already there. And we have people who come in every month that say, listen, I think I can still do this on my own right now, but I know there'll be a day when I can't. And I want somebody to be able to deal with my spouse if something were to happen to me, and I want to help put that roadmap together. And we do that. We think it's important to understand. One of my favorite lines, because it gets people laughing and it kind of breaks the ice a little bit, but it's true. 10% of us die. Now just think about that for a second. 10% of us die. 90% of us will go through that process of diminished capacity. And yet when somebody comes in our office to do legacy planning and we sit down and work with their attorneys or whatever, or I review their documents that they have, and make no bones about this, I'm not an attorney, don't play one on radio nor TV, but I've done a lot of estate planning over 3 decades worth of work. And when I sit down and I read these documents, invariably it talks about your death and who gets the money. And the amount of space, the amount of ink that's used that deals with how we take care of you when you no longer can take care of yourself, and how that's determined is in very, very, very small amount of the document. And if only 10% of us drop dead, don't you think that more attention ought to be paid toward the 90% who go through the other stage, the diminished capacity? I sure do, and that's what some of the planning we do. Now, setting that plan up for your kids, the more instructive you can be, the better off you're going to be, and that's one of those strategies. So, I try not to be the painter who doesn't have his house painted, because that's the old expression. You're at the last house painted, it's the painters. I do my best to keep up on this stuff, to work with people on my planning team to encourage me and force me and ask questions. So, to keep the trust documented and updated and those kind of things. I try to eat my own cooking, as if you will say. But it does us no good to have great ideas and not put them into action, right? So, to know and not to do, you might as well not have known in the first place. So I'm very honored and appreciative that you're listening to the show today, wherever you happen to be. But I would ask you to take advantage of what it is we're talking about and actually do something. It really is about you and your heirs or your parents. Let's just put that strategy together while we can.
Well, a lot of this talked about defining, diminished financial or capacity. And you talk a lot about your trust and how you have it set up. So is that something like you define yourself before it happens, or is there?
So here's what happens. Inside of a trust, you have a trustee that is normally you, right? And then you have a successor trustee. That's who takes over when you can't do it, right? Mm-hmm. But it's a nuclear weapon, right? When you take over, I've lost all rights, privileges, and controls. You are now making the decisions. And people are very reticent to do that. They just don't want to take the car keys from dad and take the checkbook from dad and take the rights of where to vacation from dad, right? So it becomes a nuclear thing, and people are hesitant to make that call, and as a result, nothing happens. And so in my trust, I kind of went through and created a checklist of things that people could look at to know when I was starting to lose my marbles. And if I couldn't do this, take this. If I couldn't do this, take this. If I couldn't do this, take that, right? So that, because you might take the choice for me to say that I can't wear my long johns out in public, right? I mean, you might say, Dad, you just can't do that. And I get that, right? But by the time you get to there to say that I can't decide where I want to go on vacation, that's a whole nother program, right? So in 32 years, I have seen people take away the car keys from dad. I've yet to see one spouse take the checkbook away from another, especially if that was the person who paid the bills.
Right. Until it's too late.
Until it's too late.
And you've seen that. What are some of the other documents you can have if you suspect maybe that your parents are becoming incapacitated?
As soon as you believe that is happening, you need to make sure that you're getting the powers of attorney documents in place so that you have the ability to sign for them. You do not want to have to wind up in court trying to be able to get things done. So a power of attorney doesn't necessarily take away all of your parents' rights, but it gives you the ability to sign on their behalf when they can't. So making sure that you have a durable power of attorney or a general power of attorney is very, very helpful. Just understand that they both stop when the person does die. When that 10% happens, the docs have a challenge working. Inside of a trust, the trust didn't die, you did, right? So the successor trustee does really get a kick in and take over many of the aspects and financial things that have to be done and taken care of.
Okay, we got a question in from Grant and Tipton. What stops the trustee if they refuse to give up the keys, so to speak?
Again, that's why I've defined it so closely inside of my documents. And the bottom line is, if you don't have anything in the document that defines that forces that, and that's why open communication is so important. I mean, it really, having that dialogue is truly critical. But it's very, very difficult without a court to be able to say this is what happens. In most documents, it will say if one or two docs and or a judge says that you are deemed mentally incapacitated, that the successor trustee can step in and take over, and then they're kind of forced to. Again, who wants to take their dad to a doctor to have him deemed incompetent? So I work with a neurologist here in town to talk about this, to try to be able to define it to the best of my ability. There is a legal issue and a medical issue, and Doc did a great job trying to help me sort that out. I am now capable of being a successor trustee for people in their trust. We just got that finished, and it'll be ready to go here in about 10 days. And that's one of the things that I will be helping people put in their documents is how do you want me to define this, right? Because we have people who walk in our office all the time now. I've done this for 32 years. The average person comes in between 55 and 65. Do the math, right? I mean, we take care of 15, 20 people that are over 90 years old. And to think that they're the same people at 92, 93, 95 that they were at 55, or 65 is not an accurate statement. And so I want a clear, defined thing. So what we have right now is when somebody comes in, we sit down and we say, Angie, if you're not acting right today, if I think you're doing something different than normal, who do I have the right to call?
Right.
And that's in every one of our files and ready to go. That should clearly be there. But then to your question, Grant, that so what? So and I know this in farm families where there is no document, or where the guy wrote his own trust. And it's like, you can come try to get the keys, but don't forget about the shotgun under the bed, right? It's it's a toughie. I mean, it really, really is difficult.
Well, and I've heard you mention this before because we always talk about, being declared incompetent, but you've talked about going to the doctor to be declared competent.
And that's really where the discussion and the neurologist and I got there. I had this brilliant idea. It turns out it's not as simple as what I wanted it to be. I'm still going to do it, by the way. If I made any major change to my trust, I'm calling my family physician and saying, by the way, I'm coming by for a little stop for you to sign a form that says, yes, I believe Joe is fully competent. Now, will that hold up in court? I don't know. The doc's telling me the challenges that we have with that and being able to declare that from their legal liability and everything else. I think I can still get it done. But if you make a major change in this world of communication that we have, right? You make a major change in your trust. I would at least shoot a video of myself explaining why I made this change. If I blocked, because all beneficiaries are not equal, right? If I got two daughters, if I did something for one daughter that was different for another, I would want to explain that to them now, not when I'm incompetent or dead, right? I would explain it to them now so they could be fully understanding of what's going on. And not everybody's up for that kind of conversation, or some would call conflict. I've just seen so many bad things on the other side, right? When somebody, hurt feelings, destroyed families, money changes people, that I would rather get ahead of that and help people have that conversation now. Hey, if you're ready for your next steps meeting, don't forget to give Angie a call. In 90 minutes, we'll give you a complimentary meeting where we sit down, tell you things that you're going to want to consider today, things you're going to want to consider in the future, and if we choose to partner together, what FEG will do for you. Give us a call, 800-928-4001. Ask for Angie. She'll get you signed up with somebody on the planning team. We are more than happy to see you and to meet with you. We will take a break and be right back. All right. Thanks for the questions, guys. Appreciate it.
And Chris from Texas, he asked what my favorite part of my trip was to Boston. And I just have to say that I did not appreciate history, I don't think, when I was in school. I know that the bicentennial year, my second grade class did the Boston Tea Party, like reenactment. But when I went this time the only time I've ever been to Boston as an adult, I felt like so tied to the history and like seeing houses that were 1636 and I just really appreciated it. It was amazing.
Someday I'll drag you to Italy and you'll see ones from 700.
Yeah, but this is us.
I
this
know.
Is our country.
But
I just felt very.
I get it. You get attached.
Patriotic.
And it's the best way to learn. I mean, it really, really is. I'm glad you had a great trip. I'm even happier that you're back home.
Yep.
All right. What's our next conversation?
Okay, next we are going to talk about the order of funding retirement accounts.
Ah, good deal. Casey? Well, good morning and welcome back to Consider This Program. I am your host, Joe Clark.
And I'm Angie Kinzer.
Happy to have you guys all along. Hey, we've had 3 interesting conversations already. Remember, if you're part of us on the streaming live, you get to see them all, including stuff that goes up on the board. Happy to have you all at 5 o'clock on Tuesday evening live. You can go right to our website at yourlifeafterwork.com to get it. If you're listening to the podcast or the radio, don't forget you have the access to the show notes. We're willing to send those. Can't reduplicate the slides that way. Odd as it is, I can put it up on a graph on a screen, but I can't put it on a sheet of paper. It's just the way copyright rules tend to work. But we're happy to have you along. We've talked about what happened in the Weimar Republic in Germany in 1922 to 1924 and why that mattered. We talked about the Big Mac Index, about what happened with Chinese currency today and purchasing price parity, a whole nother PPP to add into your vocabulary. We just got done talking about how to deal with dementia and the 3 layers or the 3 onions, if you will, of what you've got to prepare for there. And now we're going to move into Angie.
Order of retirement funding accounts and why.
So this is the big question that I get more often than anything else, and this is why we do everything we can at the Financial Enhancement Group to keep things simple. We want to really, really, really keep it easy. Right? So, if you want to do this on your own, that's your business, and that's fine. If you're looking for a fiduciary, that's our business, right? And like I said, you can give Angie a call at 800-928-4001. To make your life easier, though, if you're going to serve as your own fiduciary, and if you've got somebody who sells you products or you have to sign stuff every time they make a change, you are not dealing with a registered investment advisor that has discretion. You're dealing with somebody who sells stuff. And that's your choice. If you want to do it on your own, that's your choice. If you're looking for a fiduciary, this is what we do. But my checklist, what I lay out in every meeting and every time we have to go to make a decision, is what I call the fiduciary focus. Everybody on my planning team uses the fiduciary focus. In order, it's risk and volatility, fees and expenses, taxes today and tomorrow, and real return. Real just refers to inflation in terms of where we are now. That's why we had the first conversation, by the way, over Germany and the Weimar Republic, was dealing with the potential for inflation coming forward. So that is your checklist in terms of where you are. And then the question of ordering money, let's pretend like you've got $1,000 and you want to know where to put it, right? So Angie's going to ask questions, and then I will try to give you an answer, but have that written down or at least in your head, right? Risk and volatility, fees and expenses, taxes today and tomorrow, and real return. That's your checklist.
Well, we can get more into the specific parts of it, but is there a specific order of operations like in saving for retirement? Just off the top of your head, which order do we go in? Like starting with your 401k match.
So the first question would be, do you have a company plan that's available? Mm-hmm. Does that company plan offer a match? Okay. That's your first question. So if you don't have a 401k or a 403b, this may not make sense. If you've got a 401k, some plans will put in 50 cents up to $1 that you put in, limited to maybe 6% of your income. So if you put in 6, you're getting another 3%. Sometimes it's a quarter, right? So you're not getting quite as much. Some places have no match at all. Angie happens to work at a place where we put money in even if they don't. So it's 100% funded on our end, just because I think it's important for everybody to have a 401k plan that can have one, right? So different plans can be structured different ways. So the first question is, do you have a company plan? And then the second question would be, what is the match? Mm-hmm. Okay.
Do some companies not have a match?
Yes. Especially during the 08 and 09 crisis, a lot of them pulled it away.
So if there's no match and there's no Roth option.
Now, wait a minute. Don't ask the Roth option. Now, you're getting
out
of order. Getting out of order.
If there's no match, would you still want to contribute to your 401k, or would you want to maybe start putting extra money somewhere else?
So if the first 2 questions have failed, right? You don't have a company plan and they don't have a match. right?
Right.
You go back to your fiduciary focus and you're going to
Okay.
ask yourself a question. And it's going to depend on where you are in the economic cycle of life. Are you in accumulation where you're just starting out, where your two goals are tax diversification development and saving the right percentage of your income? Have you moved up to preservation where what you're adding today is not as significant as what you've already accumulated, right? Or are you going into distribution where you're worried about volatility and taxed and the tax rate on the average dollar that you pull out? So if you think about an airplane going up and landing come down, we all go through those three phases of finance. We just refuse to recognize it. So if you told me you were 25 and you hadn't had a savings account, hadn't started yet, and you were committed for this money for retirement, right? Then I'm going to ask you, do you think you're going to make more money in the future or less? Because that's going to impact what your tax rate is, right? And in the fiduciary focus, it's not just taxes today, it's taxes today and tomorrow, right? So I would prefer you use a Roth IRA in the situation we already laid out, right? Because you have no match or you have no company plan at all. And if you qualify for a Roth IRA, you're paying the taxes on that money today, but you're putting in money that will never be taxed. It will also give you a little bit more flexibility along the way. Now, if you had a company plan and it offered a match, the next question is, does it have a Roth option in the plan, right?
Yes.
And if it has a Roth option in the plan, again, you're looking at your taxes. I would encourage you to use the tax diversification, to use the Roth component if you thought your tax rate would be higher in the future. Now, the interesting part and what you have to understand is I deal with people that tend to be 55 to 64 and they're 2 years one side of retirement or another is when most people find us. Now here lately it's been a lot of 70 and 75-year-olds, but that's 32 years of my career, it's been that bundle over that period of time. And we watch people come in with $1 million all in a 401k tax deferred, where every bit of it's going to be taxed at some point in time. And some of it's not their fault. They weren't around when the Roth was available, or they were saving and accumulating before Roths even existed, right? And sometimes it's just because we didn't know any better. But we want to build that tax diversification along the way. And that would be the order that I would tell you to go in. Do you have a company plan? Does it have a match? What do you think your future tax implication is? Does it have a Roth option? If it doesn't have a Roth option, I would fund the Roth IRA, especially if there's no match. If there is a match, you got to take free money first.
If you've not contributed the max to get your match on your IRA or 401k,
There's no match on an IRA.
401k, should you be contributing to a brokerage account before then?
So again, you get into that tax diversification part, right? So I would always tell people to use their first dollars up to the match, right? I mean, I believe in that. Free money is hard money not to get. Now, if it's a dime on the dollar or if it's 25 cents, right? But if it's a 50-cent a match up to a certain percent, you want to work hard to get up to that 6%. And once you get to the full part of that match, then you reevaluate with dollars. But folks, when we're younger, when we're starting out, a lot of us don't have 401ks. We don't have company plans. And that's really where you want to build that tax diversification. That means you have some money that's already been taxed that's available. We don't know what the tax rates are going to be in the future. I have an opinion, but we don't know, right? We don't know what the system's going to look like. Again, I have an opinion, but I don't know, right? The only thing I can be certain about here is how we want to behave, and we want to give ourselves option. I want to have the least amount of friction for you financially that you can possibly have. That means I want to control risk and volatility. I want to reduce and eliminate fees and expenses where I can. I want to pay attention to taxes today and tomorrow. And I want to focus on that real return, making sure that we have money that we can actually use, because that's why we're doing all this, right? So you can have your life after work.
Well, do you want to mention what the amounts are for 2020 that you can contribute to a traditional IRA?
If you're under 50 in 2020, you can put in $6,000 into an IRA or a Roth IRA or half into each. The total in the IRA world is $6,000 if you're under 50. And if you make enough money, you can also fund your spouse, right? Now, if you make too much money, you can't put money in a tax deferred IRA or you can't put money in a Roth IRA. So again, there are some income rules that get there. Inside of a 401k, well, over 50, you can put in $7,000 a year. So since one of us, even though Angie and I graduated the same year and we're born real close together, one of us can put in $7,000 a year because he's over 50, right? So he's eligible to do that and does that every single year. In the 401k, there is an amount you can put in up to age 50. And then there's what's called a catch-up provision that lets people put in more, where the IRS has acknowledged that, when you were younger, raising a family, buying homes, maybe you didn't have as much resources to be able to put in. Now we're going to let you catch up and put in a little bit more. Technically, that $1,000, the difference between the $6,000 under 50 and the $7,000 over 50, is considered a catch-up provision for your IRA.
Well, if you do have a very high income and can't contribute, what are your options? I mean, how would you know if a conversion is right for you?
Well, there's a lot that goes into that, and we can't cover that in the remaining segment of the show. I would tell you, if you're in that situation where your income is high, you've got IRA money that's already built, or you don't have an IRA, it's a perfect time to be able to talk about a backdoor Roth IRA. The planning team can help you with that. Chris is online right now. But you can give us a call at 800-928-4001. Tell Angie you want to get signed up for a next steps meeting, right? That's where we'll sit down. We'll tell you things you need to consider today, and we'll tell you things you're going to want to consider in your future. And if we choose to partner together, things that FEG will do for you. Those 5 critical elements that we break down in that meeting are the 5 areas that I went through when I taught at Purdue and said, hey, here are the 5 areas that can wreck you financially, right? It's your life after work. It's not planning for proper retirement, right? It's because retirement is a lot different than what people think it's going to be when it starts. So your life after work. The second is the annual tax planning. It has to be done annually, and it needs to be done way before you get to December 31st, because then it's too late. The investment playbook is how you deal with that risk and volatility. How do you manage money in the middle of a pandemic? How do you make decisions in this kind of volatility and craziness of the world? Right. The 4th is life happens. It's things that's going to happen to you one-off. We have people who we take care of for years that all of a sudden show up and go, Dad just died. What do I do now? Or, I've watched kids be born, and now I've watched kids be married in the same household. That's pretty cool. I've enjoyed my career immensely. And then last but not least is the legacy plan. When I'm gone, when I can't do this on my own, who does it for me? Or when I'm gone, who gets it? Give Angie a call, 800-928-4001. All right, guys, I hope you enjoyed that. Those are 4 different segments.
We did have a question come in right at
Okay.
the very end from Phyllis and Anderson, and she says, "Aren't investments risky? My husband's always told me to invest in CDs because they're safe."
It's a good question, Phyllis. Let me give you a longer answer here while we're at this part, and we'll address your question live on the show though when we come back as well. But all investments have risk. So what your husband taught you about and what most people focus on is what's called principal risk. Principal risk is that I have less money tomorrow than I had today, right? So if your husband was a CD person, and I have a lot of people like that I've taken care of over the years, they'll always go back to 1980, the peak of inflation, and remind people of the good old times when they could get 14% a year on a CD. That was, as far as I know, that was the peak. I've had people tell me they got 16. I'm not sure what bank that would have been. The peak of inflation, that was 1980, and people were getting 14% on CDs that were longer term. Those rates went down over a period of time that they were able to get when the CDs came due. That's called reinvestment rate risk, right? So if you think about this, and it's an example that I use for people all the time, you had $1 million, let's say in 1980, and at 14%, you had an annual income of $140,000 a year, right? Now, all of a sudden, in 1990, when your CDs renewed, they renewed at about 5.5%, and your income went from $140,000 down to about $55,000. That's where we talk about that reinvestment rate risk, and it's why in the fiduciary focus, I talk about how important that real return is. You had a real loss of 2/3 of your income plus all of the inflation that went along with it. So a very, 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 very challenging period of time for people that have had a bunch of CDs that have renewed, that still have this mentality that I never want to see that value go down. And what you really have to have is the diversification part, and to help build it. CDs have inherent risks. They're just not principal risks in the system that we live in today. But they are inherent risks and reinvestment rate risk. Thus inflation rate risk, some people would call that, those kind of things.
We have another question. Do you want to take it now
Sure.
or for our outro? Okay. I hear often that you need to replace a certain percentage of your income when you retire. Is that true?
Okay, we need to save that one for the. We'll
Yes.
save that. We'll leave Elf and half for another outro, and we'll take care of that one at the outro. Great questions, Phyllis and Aaron. Thank you.
Okay.
Let's go ahead, Casey. We'll get her started. Well, good morning and welcome back to Consider This Program. I'm your host, Joe Clark.
And I'm Angie Kinzer.
And we had two questions that came in during the break that we want to make sure that we get. So,
Okay, so one of them is from Aaron, and it says, I hear often that you need to replace a certain percentage of your income when you retire. Is this true?
you need to replace 100% of your standard of living. Right? So if you lived on 60% of your income, you need to save 60%. If you lived on 110% of your income, which believe it or not, some people try, if you do that, then you need 110% of your income. So it really varies. There is a lot of people out there who will tell you the number is 70%. There are generally people with lower income that live on the East and West Coast. I don't believe an average has anything to do with your life. You are unique, Aaron. I would strongly encourage you to understand that we need to replace 100% of your standard of living and make sure that you build a plan that allows that to be built and covered. We help people with a retirement practice year and a retirement budget so that they can deal with social and fixed expenses, which are two very different things that bring in the equation of what we talked about in the fiduciary focus, where you're dealing with risk and volatility, fees and expenses, taxes today and tomorrow, and that real return in a coordinated plan to make sure that you're living on the right amount of money.
And then the other question came from Phyllis that said, aren't investments risky? My husband's always told me to invest in CDs.
Yeah, remember, all investments carry risk. There's about 11 different risks to money that are out there. In a CD, you have no principal risk, meaning that the value is never supposed to go down on paper. But in a stock, you have a variance where the stock could go up in value or could go down in value. In theory, you have the ability or the opportunity to lose principal. You also have the opportunity for greater gain. So all investments have risk. And when all of those risks are on the table and identified, what we try to help you do is to understand your level of that volatility that you can take. There's a lot of people who aren't in the stock market because they think about 2008s and 2000s, et cetera. Bond market is also another risky environment. If you look at it, it's just a different level of risk than stocks. This is where diversification, Phyllis, really comes into play, where our investment team is able to work with you to put together the right portfolio for you that deals with all four of those areas that we talked about. Risk and volatility, right? We want to make sure that we're doing it in the cheapest way possible from a fee and expense standpoint, the most efficient, as I probably should say, as opposed to cheap. The third is, let's pay attention to the taxes. We worry about getting a 2% or a 3% or a 10% return on our investments and then pay no attention to a 20% tax bracket, right? And then last but not least, we can't let inflation destroy your lunch. And that's what will happen if you live long enough staying inside of the CD environment. Hey, folks, thanks for being part of the show tonight. 800-928-4001. Have a great week.
Yeah, so you can call us for...
Yeah, we're really we've never done this on a digital format before, where we've invited people to come in and really understand what's going on. I am very, very committed to teaching people about those critical tax decisions that will impact your retirement. I've been doing this lecture for probably 8 years, and I'm writing a new one right now. All of you that are watching this have a program that in 1980, I think we kind of got sold, and it's 1978, but got sold a bill of goods into what's called defined contribution plans. When you had a pension plan, you had to, by law, have somebody like myself, Adam Harder, our chief investment officer, Andrew Thrasher, our chartered market technician, and one of our portfolio analysts. You had to have somebody like them manage your money behind this curtain in a pension fund. And then they sent you a check every month. You didn't get a statement that said, oh, it went up, or oh, it went down. You didn't have that volatility of emotion that went in. And those were called defined benefit plans. We moved in 1978 toward defined contribution plans. Those are 401ks or 403bs, where suddenly you no longer needed a CFP and a CFA and a CMT, the things that you would have had before. Now you were taking care of the money on your own, and nobody really paid attention because it wasn't a lot of money. Well, little by little, that little sum of money grew up to be a great sum of money. And nobody ever asks what's wrong when it looks like it works. Right? And the bottom line is when you're sitting there and the value of that account has gone up over the last 30 years in what I would call the accumulation and now preservation stage, it looked like it worked. And oh, so what? What's the big deal? Well, the problem is you go into that form of distribution. So it's the new program is going to be about defined distribution and what that looks like and what you need to consider. So we're opening this up for the public. It's a freebie, complimentary. Angie doesn't like the word free, but it is. I want you to understand there's no, I mean, if you want a next steps meeting, we want you to ask for one and we want you to come in. But other than that, the deal is very, very simple. I'm going to spend 45 to 50 minutes and give you education of understanding how your tax return really works. So when you look at that fiduciary focus, risk and volatility, fees and expenses, taxes today and tomorrow, and then real return, you're going to understand why that tax journey, not a one-hit wonder, not a 1040, but a tax journey, why it really matters to you.
Yeah, and we'll be doing that tomorrow at 1 o'clock.
1 p.m. on Wednesday and then 7 p.m. on Thursday.
Yep, and it's super simple. It's going to be done via Zoom. So give us a call at the office. Heather or I, either one, can give you a code. All you do is log in, put the code in, and voila.
800-928-4001 or go to yourlifeafterwork.com. Folks, have a great week. We'll see you again next time.